Okay. What is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to be doing some analysis on the current oil price as well as how is that affecting the stock market. So, as you can see here, oil is up again today to $105 for crude oil futures. If you look at the last year, this is up 47% in the last year. If you look at the last 5 years, this is almost as high as where we were in 2022. And if you were in the market at that time, you remember that there was a huge crash that year, and I want to say the index was down over 25%. So it looks like we're getting pretty close to that again. And, the thing I'm always looking at too is these PE ratios, right? What sort of valuation and premium are investors paying for the stocks in the market? So, this top pink line here is the Magnificent Seven, okay? So those are the big ones that you hear the most about, and you can see that if you look at the last 10 years, we're on the lower side now. Those have definitely come down. I think like especially ones like Amazon and Microsoft, those are cheap now. Those are in pretty cheap territory. So that's not really a problem. Then we look at the blue and green line, which is small cap and mid cap. Those are definitely on the cheaper side. And, even look at where they were in 2022. Look how cheap they were then. So those have recovered a little bit since then, but they're still on the cheaper side. Then the red line is where we're kind of in the middle because it could go either way from here. As you can see, the red line between really, if you look from 2019 to now, we are sort of in the middle because 2019, it traded all the way down to about 14 times earnings. 2022, it traded down to about 15 times earnings, and then last year we got down to about an 18. But at the same time, we've also seen it hit about 23 times earnings twice since then. Two or three times it's been about 23 times earnings. So between 23 and between, let's say, this 17 mark or so, 17, 18 maybe, we're somewhere in the middle there because right now we're right under 20, right? So we're in between a 19 and a 20 for the S&P large caps forward PE, okay? Now, if you look the previous 10 years, let's say just before 2020, in general, these lines were much more, not only were they closer together, but they also were at lower valuations. I mean, look at the red line. The red line was anywhere from 2013 to 2019. The red was usually trading at around 16 times earnings, right? Now we see the red trading at more like 20 times earnings. So really, I can see S&P large caps either staying where they are, pretty, somewhere in this range. Technically, they could go back up. They really could go back up if we have that catalyst in the market. But as we're about to get into, we don't really have that catalyst. We have a lot more problems going on as far as politics and geopolitically, the war, the oil prices. It's not like employment is that good. We have AI is technically a catalyst for the huge corporations. Maybe it's a earnings and profitability catalyst for a company like Microsoft and Oracle and some of these other ones. But in terms of the average person or small businesses and stuff like that, I don't know if, I mean, I guess AI can be a technically AI can help with profitability and earnings even if you're a smaller business, but for the jobs it's going to replace, that sure doesn't help, regular Americans and consumers. So from consumer spending, I don't see that getting too great anytime soon. And then in terms of employment numbers, I don't see that getting too great anytime soon. So it really just kind of makes it where if you're a business, maybe a business owner or certain organizations are benefiting from, AI efficiency and profitability. But with that aside, there's a lot of other problems going on. I mean, with inflation and oil prices right now, that's definitely not helping the average consumer. So you have those things kind of weighing down on Americans and consumer spending. We'll see what happens with interest rates. Interest rates are kind of in the middle right now, not really doing anything crazy. But in terms of the stock market, again, we see the blue and green lines should come up from here. They should go up to a more normal range. The pink at the top has come down to a healthy spot. Like I said, a lot of them are in pretty cheap valuations. Like you look at Microsoft right now, it's pretty cheap. But it's your regular companies that are the red line, the large caps in the index. where I could definitely see those coming down more. And if we look at 2022, again, those oil prices are pretty similar to where we were 4 years ago. So, and oil is a pretty, important factor in the economy and how much it costs businesses to do business. So, realistically, I see the red line coming down a little bit more. And, I mean, it doesn't, we might go back down to 15 times earnings here, right? That would maybe be a little bit extreme, but it's possible. I would say like 18 times earnings for this red line down to here. That's pretty realistic. And so if we take a look at the index here, you can see that I definitely have a position here, but I am saving most of my cash right now for when this goes to, let's say, $500 or cheaper. That's where I would really like to spend most of my cash right now is on the QQQ at $500 or below. So that's kind of all I have for this situation. Let me know what you guys think down below, and I will see you in the next video.